Income statement analysis. One of the most easily understood financial statements is the income statement, also called profit and loss statement. The top line of the income statement is sales. One can compare the sales figures of an enterprise over the years to see whether it is growing or not. This comparative analysis over several years or months is called a time series analysis or a horizontal analysis, since the sales figures are usually put along a horizontal plane. The growth rate from year to year can be computed on a percentage basis. Below the sales figure is the cost of goods sold, also known as cost of sales, which reflects the cost of making the product itself or of delivering the services directly to the customers. If one subtracts cost of goods sold from the sales figure, one obtains the gross profit or gross margin. Analysts pay particular attention to the percentage or ratio of cost of goods sold to sales and gross profit to sales, because these percentages indicate whether the cost of producing the product is becoming higher or the selling price is declining. In either case, the percentage or ratio of cost of goods sold to sales will go up. When this happens, the gross profit to sales percentage ratio will necessarily decrease. The reverse will be true if costs go down and selling prices shoot up. Proceeding with the rest of the income statement below the gross profit figure, the accountant lines up the operating expenses, also known as selling, general, and administrative expenses. The various expense items that are not directly part of the costs involved in making the product or delivering service are included here. The typical operating expense accounts are as follows: salaries and wages, sales commissions, rentals or office leases, advertising and promotions, professional fees, travel and transportation, training and education, employees' benefits, light, water and power, office supplies, depreciation of office furniture, equipment, and leasehold improvements, representation expenses, miscellaneous or other expenses. The analyst monitors these expenses very carefully because many of them can go haywire if left unchecked. During good times, management splurges a bit more on some of them, but during bad times, drastic cutbacks are made. Analysts likewise compute for the percentage or ratio of the total operating expenses to sales, as well as for each of the individual operating expense items in relation to sales. However, many of these operating expense items do not necessarily have any correlation with sales. By and large, many of them are budgeted with some amount of discretion. At the beginning of each planning period, top management sets limits on what the enterprise can spend for each expense item. Some expenses, though, go up and down directly and proportionately with sales. An example is sales commissions. These are usually given to salesmen as a percentage of their sales. The advertising and promotions budget are sometimes pegged as a percentage of sales, but that policy is arbitrarily set. Management can actually fix the amount budgeted for this expense item. Some costs behave differently from others. Variable costs are costs that necessarily, directly, and proportionately move up and down with sales. Examples are raw materials, labor, electricity, and sales commission. The other costs are largely fixed, meaning they do not necessarily directly and proportionately go up and down with sales. Fixed costs may increase or decrease over time, but may have nothing to do with the movement in sales at all. For example, salaries, representation allowances, travel and transportation, office rental, and others can escalate, but their doing so does not make them variable costs, since they are raised or lowered purely on the discretion of management. They are essentially fixed costs. After deducting operating expenses from gross profit, the accountant derives operating profit. Again, the percentage or ratio relationship between operating profit and sales must be established. From operating profit, the accountant adds all non-operating income, such as earnings from other investments, the sale of assets, interest from money market placements, and subtracts non-operating expenses, such as interest expenses, extraordinary losses, etc., to derive net profit before taxes. Taxes are deducted to get net profit after taxes. Once more, the analyst gets the percentage or ratio relationship of each of these items to sales. The analyst lines up sales, cost of goods sold, gross profit, operating expenses, operating profit, non-operating income, non-operating expenses, net profit before taxes, taxes, and net profit after taxes in a column. Then, he computes for the percentage or ratio of all the items in relation to sales. Sales are made the index for everything else and set at 100% or 1.0. The rest become lesser percentages or ratios of sales. Called vertical analysis, this process is illustrated in Table 21. By doing the horizontal and vertical analysis over several years, the analyst can come up with what is termed the common size analytical format. The common size format involves translating all the financial figures over 2 or more years in common or percentage ratio terms. This is done to easily detect trends and patterns in the movement of all sales, cost, and expense items over time. What the analyst does is to set all the sales figures over several years at 100%, or 1.0 if using the ratio approach. What this methodology fails to capture, however, is the year-to-year percentage growth. Table 22 gives us an illustration of the common size format. From the common size income statement in Table 22, we can easily spot the culprits responsible for bringing the net profit percentage down from 4.5% of sales in 1997 to only 1.5% of sales in 1999. These culprits are the increasing percentage of cost of goods sold, the absence of non-operating income in 1999, and the 1% increase in non-operating expenses in 1999. However, operating expenses actually decreased by 2% during the same period, thereby cushioning the effect of the three culprits. Since the sales, cost of goods sold, and operating expenses are all expressed in monetary terms, the analyst must isolate increases in these items due to price escalation and increases due to volume or quantity changes. For example, rising sales may reflect industry-wide inflation, but may hide the fact that volume is not climbing, and therefore, the market share of the enterprise may actually be falling. Balance sheet analysis. The balance sheet items are logically arranged by the accountant for convenient analysis. Looking at the asset side, the different accounts are presented according to their relative liquidity or convertibility to cash. Of course, the number one item is cash itself. This is followed by marketable securities, like bonds, money market placements, and corporate shares that can be easily sold in the stock market. Next comes account receivables, which are normally collectible within the month, or a couple of months. Inventories follow. These still need to be sold and transformed into accounts receivables and later into cash. Other current assets bring up the rear of the current asset accounts. As discussed earlier, current assets are those convertible to cash within a relatively short period of time. The next group of accounts are fixed assets led by land, which is the most saleable among them. Next comes buildings, which take a bit longer to liquidate. This is followed by machinery and equipment, which may be too specialized for the product being produced and thus be harder to dispose. The last group is composed of other assets, usually intangible, such as organizational development expenses, which are enterprise creation expenses, e.g., feasibility studies, pre-operating expenses, etc. They are capitalized or regarded as assets to be amortized, i.e., depreciated over a few years. Goodwill also comes under other assets. It represents the premium price paid by the enterprise on assets or corporate shares bought over their stated book values. Both organizational development expenses and goodwill are intangible assets that are very difficult to sell, if they are at all saleable. The liabilities side is also presented by the accountant in a similar manner. The liabilities that must be paid in cash first are put on top, while those to be paid last are placed at the bottom. Leading liabilities are suppliers' credit or accounts payable, which are obligations to suppliers who usually expect to be paid in a matter of days or in a couple of months. Other short-term payables, such as accrued wages and taxes, follow. Next come the short-term notes payable, or all debt obligations due within 1 year. The first group of liabilities, therefore, is composed of current liabilities. These are financial obligations that must be paid within 1 year. The second group of liabilities are long-term debts, or notes payables. The third group of liabilities is composed of owners' or stockholders' equity. Owners do not intend to get paid back by the enterprise, but they definitely expect to receive dividends over the course of the enterprise's life. The owners can sell their stocks in the enterprise, but this has nothing to do with receiving payments from the enterprise as such, because the enterprise is not the entity buying or selling the stocks. The logical arrangement of the assets and liabilities in the balance sheet allows the analyst to match current assets with current liabilities, which are both presented on the top portion. Since, due to their highly liquid nature and easy convertibility to cash, current assets will be used to pay for current liabilities, the matching enables the analyst to compute for what are called the liquidity ratios. The first liquidity ratio is the current ratio. It is simply the ratio between current assets and current liabilities. The second liquidity ratio is the quick ratio, otherwise known as the acid test ratio. The quick ratio takes only the very liquid current assets, or quick assets, composed of cash, marketable securities, and accounts receivables, because the inventories have not yet been sold, and may not get sold for some time. The analyst obtains the ratio of the quick assets and the current liabilities to derive the quick ratio. The liabilities column is divided into current liabilities, long-term debt, and owner's equity. This makes it convenient for the analyst to compare the total debt, composed of current liabilities and long-term debt, with the owner's equity to gauge the financial risk level of the enterprise. Presumably, the bigger the total debt to owner's equity ratio, the more financial exposure and risk the enterprise has. However, the analyst may only be interested in the long-term debt to owner's equity ratio, particularly if he is comfortable that current assets can meet the payment schedule for current liabilities. The total debt to equity and the long-term debt to equity ratio are called solvency ratios because they try to approximate the relative financial risk being taken by the enterprise. The third group of ratios are the profitability ratios. The net profit after taxes of the enterprises are related to the sales, assets, and owner's equity of the enterprise. The ratio of net profit after taxes to sales provides the return on sales, or ROS. The ratio of net profit after taxes to assets gives the return on assets, or ROA. The ratio of net profit after taxes to owner's equity yields return on equity, or ROE. In computing the ROA, or the ROE, the analyst sometimes uses the assets or owner's equity as of the ending balance sheet. The more correct approach, however, is to average the beginning and the ending balance sheets of the income period. Finally, there are the activity ratios. These ratios allow the analyst to gauge the efficiency, effectiveness, and economy levels of enterprise operations in financial terms. The first activity ratio is the asset turnover ratio. It measures how much sales are generated by the assets of the enterprise. The assets are actually the investments made by the enterprise in the form of working capital or current assets, fixed and other assets. If the enterprise can squeeze a lot of sales from the assets or investments made, then it is efficient, effective, and economical in its use of resources. The analyst may also wish to make variants of this ratio, such as the sales over current assets ratio, or sales over fixed assets ratio, which relates sales to specific forms of assets. The second activity ratio is the inventory turnover ratio. It focuses on the inventories of the enterprise in relation to the sales generated or the cost of goods sold. What the ratio does is measure how many times the enterprise can turn its inventories around in a year. If a furniture enterprise displays 50 pieces of furniture at any one time in its showroom, and it sells 500 furniture pieces in a year, the furniture inventory therefore turns around 10 times. Expressed in monetary terms, the analyst obtains the cost of goods sold for the year and then divides this by the average inventory, which is the average of the beginning and ending inventories of the income period. The account cost of goods sold is chosen because it has the same cost per unit of furniture as the finished goods inventory. Hence, there is no cost difference that would otherwise misrepresent the actual volume or quantity turnover. However, some analysts use sales over average inventories if cost of goods sold are not available. The third activity ratio is the average accounts receivables collection period, which is the ratio of accounts receivables to credit sales, which excludes cash sales. This ratio approximates the average age of accounts receivables, or how long it usually takes to collect from customers who bought goods on credit. The ratio is derived by dividing accounts receivables by the annual credit sales. The average accounts receivables collection period is thus obtained. In terms of days, the average collection period is 0.0833 multiplied by 365 days in a year, or simply 30 days in 1 month. One can also derive this by dividing the annual credit sales by the number of days in a year to get sales per day. Then, the outstanding accounts receivables is divided by the sales per day. The balance sheets as of the ending dates from several years can be put in common-size format. The objective is to detect patterns and trends, which indicate whether assets and liabilities accounts are rising or falling as a percentage of total assets or liabilities. Table 23 reveals the rising percentage of current assets from 1997 to 1999, paralleled by a corresponding increase in current liabilities. Long-term liabilities are fast dropping as a percentage of total liabilities and owner's equity, but the owner's equity is moving up. Now that we know the jargon of the financial analyst, let us bring the ratios into the proper perspective of the fund manager. Let us begin with liquidity ratios. Many finance textbooks talk about many rules of thumb when interpreting ratios. They say that it is good to maintain a 2-to-1 ratio between current assets and current liabilities. The generous allowance, where CA is double CL, is supposed to provide the needed buffer just in case certain accounts in the current assets do not convert into cash. There may be accounts receivables that do not get collected and inventories that never get sold. When these happen, funds are frozen and do not flow. What is really essential is not the 2-to-1 ratio per se, but that sufficient funds from current assets flow are converted into cash and are used to pay for short-term obligations, CL. Therefore, what is crucial is the flow potential of the CA accounts. For example, let us take two enterprises, ABC Company and XYZ Limited. From a pure ratio perspective, ABC Company has a higher current ratio, 2-to-1, than XYZ Limited, 1.5-to-1. Analysts may jump to the conclusion that ABC Company has a superior liquidity position, but this is not necessarily so. ABC may have a lot of uncollectible or frozen accounts receivables and unsaleable inventories. If so, then its funds flow potential is low. XYZ Limited actually has 600 pesos in cash, which can pay for all its current liabilities. In fact, it has higher funds flow potential because it has a lot of cash floating around. Even if the accounts receivables are not collected, and if inventories are not sold, it is still liquid enough to pay for all the pressing short-term obligations. The same caveat applies to quick ratios, but to a lesser degree, because the funds flow potential of the quick assets is inherently higher and will therefore have lesser chances of becoming frozen. Decreasing ratios are not always bad trends from the fund manager's viewpoint. Again, let us take company LMN Incorporated. It has CA of 200 pesos and CL of 100 for a 2-to-1 current ratio. If LMN Incorporated wishes to expand, it would have to increase its working capital, particularly inventories and accounts receivables. Supposing it decides to expand sales by 50%, the CA would also go up by 50% since working capital usually rises and falls with sales. This would mean adding another 100 pesos to working capital and raising enough funds to finance the additional working capital. LMN Incorporated may then decide to raise 100 pesos in current liabilities. The current ratio has decreased, but this is a purely mathematical phenomenon. It does not mean that the liquidity position has actually deteriorated. As long as funds do not get frozen or lost, there will be the same flow potential, but this time, the additional working capital is supposed to generate additional sales and therefore additional profit. Let us suppose that the profit realized from the additional cash sales comes up to 100 pesos. What we would have is CA of 400 pesos or 300 plus 100 and CL of 200 pesos. This brings us back to the 2-to-1 ratio. But this time, there is a higher cash component coming from the additional profit generated by the cash sales. Return on equity derivation. As far as stockholders or owners are concerned, the most relevant ratio is the return on equity ratio, or ROE, which relates net profit to owner's equity. The ROE is actually the joint effect of the return on asset ratio, or ROA, and the total assets over owner's equity ratio. ROA relates net profit to total assets. ROA is actually the equivalent of return on investment, or ROI, since the enterprise invests in assets. Total assets over owner's equity is a measure of how much financial leverage the enterprise has. Total assets equal total debts or liabilities plus owner's equity. Therefore, when total assets is divided by owner's equity, the resulting ratio measures how many times the owner's equity is leveraged by debt. Let us compute the ROE using ROA and total assets over owner's equity. In turn, the ROA is the net effect of the return on sales, or net profit over sales, multiplied by the asset turnover ratio, or sales over total asset. The derivation of the ROE allows the analyst to find out what factors contribute to or erode profitability insofar as the owners are concerned. The analyst can concentrate on net margin, or net profit over sales, asset turnover, and financial leverage, or assets over owner's equity, in trying to increase ROE. Analyzing activity ratios. Focusing now on two important activity ratios, the average accounts receivables collection period and inventory turnovers, the analyst should be careful to distinguish between deliberate investment decisions of fund managers and loss of control over accounts receivables and inventories. Some fund managers may actually want to prolong the accounts receivables collection period as a marketing ploy to get more customers. For example, instead of providing credit for only 30 days to customers, the fund manager may extend this to 60 days in the hope of increasing sales substantially. Similarly, The fund manager may wish to add inventories of merchandise that have high profit margins but slower turnovers. Doing so would bring the average inventory turnover down. These two decisions make sense because the additional profits from the additional sales are expected to outweigh the additional financing costs or interest expenses incurred to fund the additional accounts receivables and inventories. On this basis, an analyst should not jump to the conclusion that lengthening collection period and slowing inventory turnovers are always ill-advised. They may, in fact, be good for the enterprise. Funds flow analysis. Finally, let us revisit the funds flow as a tool for analyzing where and by how much the enterprise sourced and used its funds. We have learned that any source of funds must have a corresponding use. This is done by comparing two balance sheets and detecting the major sources and uses of funds. Has the fund manager essentially sourced long-term fund to finance long-term uses and short-term sources of funds to finance short-term uses? Or was the fund manager foolish enough to source very short-term funds to finance very long-term uses? Table 26 shows how long-term funds of 300 pesos from additional long-term debt and owner's equity were used to finance long-term uses of 300 pesos in the form of fixed assets. Also, short-term funds of 200 pesos from increased current liabilities were appropriately used to finance short-term uses of 200 pesos in the form of accounts receivables and inventories. This ends Chapter 4. We can now go to Chapter 5, Financial Forecasting.